Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Let's do it. Hi, and welcome to the podcast. Today is the 15th of September, 2023. I'm here with Julian Muldoon. Julian, I've known for quite a few years now. We sit in a few groups together where we end up at a few medical sort of stuff together. And me being an accountant who does a lot of medico, Julian, who is property advisory, who does quite a bit of medical as well. So Julian from one group, Property Advisory, thanks for joining us. And before you kick off, I guess, property advisory, it's one of those things like, what is it? It's sort of a buyer's agent. It's a bit more than that. Explain to everyone so we don't have to go into that detail later.
Yeah, thanks, Brandon. Good to be here. Property advisory, you're right. It's a bit of a broad term. I guess the most common term around acquisitions would be buyer's advocacy or a buyer's agent, which most people are aware of, which is a buyer representative who's independently paid by the person that engages them. I guess where property advisory comes in is the more strategic element of it. So it could be investing, 1 to 5 mil. What do I do with it? Commercial, residential, Melbourne, Sydney, Brisbane. Do I buy and hold, or buy and subdivide, or do I renovating and selling? So a bit more strategic play. And I guess our involvement is very much leaning on the accountant and the financial advisor to make sure that strategically everything's aligned with their goals. Whereas a typical buyer's agent might be like, hey, I want to buy a property in Paddington, or hey, I want to buy something, a holiday house in Noosa. So there's definitely a buyer's agent component of what we do, but we're also doing portfolio reviews and business location strategy and lease negotiations and project management. So a little bit more diverse.
Yeah, it's not just, hey, I want to buy a property. Oh, great, here's one, I'll negotiate for you. It's a hell of a lot more than that, which is pretty cool. So it's a nice little business you guys run, and I guess you do a fair bit in that space. So you're definitely the man to talk to. And I mean, you and Tass deal with, all over the place, I guess, but Brisbane, Sydney, Melbourne, all up and down the East Coast. Is that your predominant market?
We pretty much stick to Melbourne, Sydney, Brisbane from a residential point of view, because it's just so fast-paced and a lot of transactions. But commercial property, slower moving market, a lot more off-market. You can put sites under DD for 21, 30 days, that kind of stuff. So, and higher price points. So we do commercial all over the country. But yeah, it's the commercial property landscape's a lot more popular now, especially from an investment perspective. So you get a lot more clients now saying, hey, do I buy residential or commercial, which we didn't really have 5-7 years ago.
Is that because, and I was going to ask you about commercial later on, but let's go into that now. So commercial, from my point of view, it's always a bit of a higher yield, but I guess it's harder to get a tenant sometimes. And as long as if someone moves out, you can just flip it around and have someone back in the next week. So you normally get a bit better yield if you've got a commercial. Is that sort of similar to what you're finding? And what is the commercial landscape at the moment? What are some of the advantages of going commercial?
Yeah, I think when you're thinking, cash flow versus growth, I mean, historically, if you wanted to capital appreciation in a property, if you wanted it to double in 7 to 12 years, or the metrics that the investors are typically looking for, that's a residential property. If all things go well, of course. And then commercial property
performance is not an indicator of future, one of those ones.
Correct. Yes, exactly. But whereas commercial property is more of a cash flow play. So typical journey of a property investor, this is very general, would be you buy a residential property in your early investing years, you hold them for at least 1 to 2 decades, and then you might cash out of some of those residential properties and buy commercial. And that's because commercial requires more of a cash deposit, so it's a lower loan to value ratio. So you've got to put down 30 or 40% deposit plus stamp duty. Plus you've got to be really mindful of vacancy, like you mentioned, because you might turn over residential property in Brisbane at the moment. You'd have it leased within 2 to 3 days, whereas a commercial property might take 1 to 3 months, even in a high demand market. And it could take even 6 months in a low demand market. Because if we're tenant reps, we're representing a business. For example, we secured a site yesterday for a stenographer, and basically they can't move in for 3 months because they've found the site, we've negotiated the lease, but now they've got to do design, construction drawings, tender a build. They don't want to take possession for 3 or 4 months. So you've got to cover these longer vacancy periods, and the interest rates are higher on commercial. So last thing you want to do is jump in on that when you're at a stage of life where you don't really want to be bleeding money to an investment. You want to be reducing debt on your home, so to speak.
Yeah, so it's a long game, but it's a better return when it's working well. And I guess that's probably the reason, a lot of our Medico clients, if you buy in your own rooms, well, that that works great because you're your own tenant and you can
Yeah,
you can control that a bit better. You're not necessarily out looking for a tenant, so you can get a decent return, but it's just yourself as the tenant.
correct. Well, you're de-risking probably the biggest risk of the whole process, which is sourcing a tenant. You're also getting a 5 to 10 year lease instead of a 1 to 3 year lease, which is pretty common.
Yeah.
And then obviously you're refurbishing anywhere from $3 to $100 to $1 million at the same time, and getting security of tenure. So yeah, I think a lot of businesses were chasing commercial property when rates were low. Like every sector seemed to be out there not wanting to lease because yields are typically 5 to 6%. So you're paying the owner 5 to 6% of the value of that asset in rent versus 2 to 3% interest rates. So everyone wanted to buy. Now most businesses are still wanting to lease and protect cash flow, we're seeing anyway, but medicos are still really, really strong on wanting to purchase.
So what, there was a 5 to 6% return you were saying. That's typically a bit low for a commercial though? Wouldn't it be more than that?
Mate, it's fascinating, mate. We saw cap rates, so the capitalization rate, the income versus the value of the asset, at about 4 to 4.5% during the good times over COVID, right? And you're thinking rates at 2%, cap rates 4. Rates have now gone from 2 up to say 6 or 7%, and cap rates have only lifted 0.5 to 1%.
Yeah, because if I'm seeing cap rate on commercial, I'm selling normally. That's that's a good rate if you've got a property, if you can sell it at that. But yeah, I think if you're buying
harder.
These 4s, that's pretty low cap rate to buy at. Particularly as you said, if you're paying interest rates now of 5, 6, 7%, well, that's tough.
Yeah, it seems like the investor mindset at the moment, and this is in the sub 5 mil, which is your typical investor that's an SME. They're maybe running a business, or they're employed, or they're senior person, and they've got a couple of resi properties they want to do commercial. They might spend 1 to 3 mil, sometimes 3 to 5 mil. So you're buying industrial assets, or you might be buying it, free hot retail that's got a services business in there. And generally speaking, what's happening is investors are saying, well, we want a quality piece of real estate, not just a quality tenant. So if the area's got low vacancy, if the property's unique, it's got great frontage, it's got good visibility, it's got great parking, we're going to get a lot of different businesses that want to be there. Vacancy risk is low. It's a 5% cap rate at the moment. So it is a real break-even exercise. Not many people are buying these commercial properties at the moment because of their high cash flow return. So the market's taken a lot longer and may not get back to where it was at the 7s and 8s, which is typically someone who's watched the commercial market 5 years ago and comes to us now and says, I want to buy commercial. They're saying, oh, my expectations are 7 or 8% cap rate. And we're saying, wow, we haven't seen them for a very long time. Unless you go new build industrial estates where there's a lot of supply, or maybe Perth or Darwin or other markets that we see is a little bit more risky.
Yeah, and I guess that's probably an indication maybe people are feeling safer in those commercial properties, and maybe there's a lot of safety in the market at that point, because the market's driven by the market. People are buying and selling. Correct. That's the rate. That's how it is.
Correct, yeah. And I think the other way you can get a better investment, said invertedly, because you are taking on more risk, is we've got a couple of industrial assets under negotiation in Brisbane at the moment, places like Willawong and some in Murray. And what's happening in around those areas is the tenant might have only 6 to 8 months left on the lease. The owner hasn't got the appetite to go through the whole process of putting the rent up or maybe finding a new tenant. So you get a bit of income, but you take on the risk that the tenant may move. And that's when you've got some regressive negotiations where you might get a 7% yield because you're taking on that risk that the tenant may be gone in a year.
Yeah, okay, fair enough. Keeping it moving a bit, just away from commercial, what are we seeing in resi at the moment? Because you guys deal with everything. Where's your put your winning tips hat on? Where's the best performing market at the moment? Where's the worst? Where should we be looking at?
Well, I guess statistically the best performing market is Sydney. And Sydney's really 3 markets. Is you've got the harbour city, the beautiful blue chip Sydney, and then you've got the west and the Parramatta city, and then you've got the new city in the very west, which is the Garden State, which is the Aerotropolis, the Badgerys Creek, the Liverpool, the Penrith, and those areas. So it's really firing out in the west. There's a lot of development, a lot of infrastructure going in, and there's a lot of demand. So you got clearance rates up around 90%. Which is a really exciting investment strategy because you get a lot of dual income properties and granny flats and things. So it's very good yields, good growth at the moment as well. So it's a bit of an anomaly. You've also got Brisbane, which is, I think, probably the best performing market consistently in the last 6-7 years. Yeah. But maybe not 6-7, maybe the last 4 or 5 years.
Definitely from just pre-COVID, it seemed to boom here a bit through COVID anyway. And it's gone gangbusters. But I'm being Brisbane based, we're a fair way to catch up to Sydney though.
Oh yeah. Well, I think but you've got price point, you've got yield. Whereas Sydney's got a very, very, very hard price point. I mean, out in the far west, 40, 50 Ks away from the harbour city, I mean, you can pick up properties for 800 to $1 million, and you can get 4% yields. That's similar to Brisbane's kind of middle ring market. Yep. But the middle ring market of Brisbane is better schools, better infrastructure, better proximity to CBD. So when we're talking to clients that are in that 800 to $1 million range to invest in property, it's really Western Sydney or middle ring Brisbane that we're focusing on. Melbourne's the flattest market. It's probably been the sluggish market in the East Coast.
Yep.
And then the market is probably on par with Brisbane and Sydney would be Perth, but we see Perth as being very boom bust, goes through really long flat periods of no return. And if you're in a situation where you want to sell an asset, upgrade the family home, buy a beach house, all that kind of stuff that you may want to do, Perth's risky because you could want to exit that market when that market's not a good time to exit, and you're really stuck holding property for a long time. Whereas you rarely struggle to sell good property in Brisbane, Sydney, and Melbourne.
I mean, most investments in property are pretty long term. But you're right. If you had to exit, you'd hate to be thinking, well, I've been here 10 years and it's made nothing. And it's been negatively geared. What do I do here? So.
Yeah, and construction levels are really off the charts in WA at the moment. What's happening is a lot of house and land being built. I mean, there's a lot of sprawl, similar to Melbourne. One of the reasons why Melbourne doesn't have the same price pressure as Sydney and Brisbane at the moment is Sydney and Brisbane are very hard cities to scale. National park, ocean, flood catchments. Whereas Perth, Melbourne, even though they're very different, we've got a lot of greenfield, a lot of house and land that can just keep going further and further out.
Just keep expanding. And I guess Brisbane too, 2032 Olympics. Surely it's not going. This is general advice, not specific, but surely it's not going anywhere for a while. Surely there's plenty of money getting poured into this state and this city.
Yeah, and you're not like Victoria, who's running out of money and sacking the Commonwealth Games, which has been embarrassing. But yeah, when you look at what's going to happen there with basically improvement of infrastructure, major projects that have to happen, a lot of federal funding flowing into the state, it's just going to improve livability and create a hell of a lot of jobs, high-paying jobs. So when we look at interstate migration, it's so strong up to southeast Queensland, largely because all those jobs are being created and it's a bloody good place to live. So when you consider all of that, the next 3 to 5 years look great. And then I guess you're going to have the Olympics and put Brisbane on the international map, which once again, it's already getting more immigration post-COVID than it was pre-COVID. So I think having the Olympics there is just going to make a lot more people realise how beautiful it is up there.
Yeah, I'm not sure we'll have that same boom that I guess Sydney had in the 2000 Olympics, but here's hoping it'll be. Hopefully, it'll still be pretty big in Brisbane, and plenty will go off.
We had a look at that. We did do some research on that, where the Olympic Park and Western Sydney in that region had a better growth period after the Olympics or before the Olympics. So it's actually pretty much the same. So having the specific Olympics in the West. But tourism obviously ramps up on the back of it, and then you would expect a lot of people that come and experience it to think, hey, this is a pretty damn good place to live as well. But it wasn't exponential based on the Olympics.
It's not as though the international people looking at the Sydney Olympics thought, oh, Western Sydney, they just saw Sydney, right? That's all they're seeing on the they're seeing a harbour bridge and thinking, I want to live there.
Yeah, exactly right.
Yeah, so look, hopefully we get that in Brisbane. Hopefully there's a bit of a kickoff. And to hold you to, I guess, best performing markets, maybe you're suggesting, that Western Sydney, middle ring, Brisbane, I think you called it. Where are the values going? But your tipping hat, obviously you're not held to this, but where do you feel values are going over the next sort of 12 months or so?
Well, it's interesting to see how quick the recovery happened. Like we had the fastest decline post-boom on history. Last year when rates started going up, market just completely dived. And then we had the quickest recovery on history. So quickest decline, quickest recovery. And now we've had positive growth for the last 5 months on the East Coast, at least anyway. And it's tapering a little bit. And we're noticing that even when we go to open homes, it's just not quite the intensity around offers really quickly as properties list. So it's slowing a touch. But everyone from a banking and forecasting perspective is saying that next year will be a really positive year in the property market. So we tend to read everyone's opinions and then we make up our own, knowing that at the end of the day, you can't forecast this stuff because it could be an anomaly like a COVID, sitting in the darkness that you're not aware of. But you would have to think that all East Coast markets will have a positive year next year. I think the market with the most leverage, though, is Melbourne because it's less competitive. And Melbourne should see really strong growth in about 12 to 24 months because we're getting a lot of immigration, which is typically renting for 12 to 24, and then they'll become buyers.
And you mentioned there was I guess there was that post-COVID, there was a drop. then a recovery, a fast recovery. What was the drop rate across the eastern seaboard? How much did it drop, and then is it back to where it was in its peak, I guess?
Well, the strange thing is every time the market has a dip, and I said inverted commas, it tends to bottom out at 10 to 15%. So when you look back at, I think it was the last 5 or 6 declines in the property market over the last 20 years, because we've had quite a lot with federal elections, banking royal commissions, talk of negative gearing and franking credit changes, and a lot of different things that have happened either politically or economically in the GFC. Every time it's had a downturn, largely driven by sentiment most of the time, more than structural things, it's kind of bottomed out at 10 to 15. At 10 to 15, people start to see value and they go, wow, the market's down, let's go. And also stock levels tend to drop 20 to 40% depending on the area. So the buyers disappear a little bit, stock levels drop, people see value, jump back in. So we tend to get a recovery once it gets that 10 to 15% bracket. There's always outside liars who maybe paid too much for their property and they hit financial troubles and they had to sell, and they lost a little bit more than that. But generally speaking, 10%, 10 to 15.
Okay. So we've sort of bottomed out and then we've clawed back. Are we back to our heights again, or are we on the way up at the moment?
So I think in Sydney we've just gone past where they were. So they're kind of past values have gone past their peak. In Brisbane, we're probably back at even again.
Yeah, okay.
Depending on when you bought in that growth cycle, pretty close to it at least. And then Melbourne, we probably depends on area. Some areas are still really struggling. Other areas are sitting at pretty good levels. It seems to be that the more premium market had the least drop, which is really surprising because it tends to be the premium leads the decline and leads the recovery. And that may be because most people are employed, a lot of wage increases, and generally people are very optimistic about property still, even though rates are high.
So that's interesting. You're saying about the property market come back to where it is, because the newspapers don't seem to report that. It's only when the market drops and everything goes down, they report it. It's a big losses. They don't seem to report that it's coming back and it's back to where it was. I guess that's always been the case.
Yeah, it's got to be extremes, I think, for it to be worth writing about. Like, to say the market's, balanced and everyone's transacting fair and equally, it's not a very exciting article, right? So it's always got to be
papers.
It's falling apart or it's booming. And then if it's booming, it's all about how the next generation can't afford property and, just trying to dramatize everything. Whereas if it's going down, it's obviously fear-mongering for a different reason. But now the property market's, it's actually in a really good state. I mean, if you can afford to hold property, there's definitely a lot of opportunities out there because not every property is getting the right price in our opinion. Like there's a lot of vendors that are really pushing to sell quick because they've committed elsewhere, and in that moment the buyers aren't there. You've just got to be active, working on a lot of properties, be really diligent with pricing and try to find those opportunities that fall through the cracks, which you won't have as much next year if rates drop and the market really surges.
So is it a good time to invest? It's not a hold, it's a looking, there's opportunities out there, there's places to look at?
100%. I think properties that need a little bit of love, renovation, maybe not extensive, but immediately tenantable. So you don't have to do the work straight away. Great opportunity. I mean, a lot of the buyers that are paying premiums are dual income with kids, and therefore they don't want to do anything. They want a ready-to-go house. So if you're happy to pick up something that's just a little bit quirky, or maybe it's original condition, hasn't been worked on for 30 years, but still comfortable to live in, great option. So there's definitely options for sure. And even properties, a lot of investors are considering selling now, and they're selling their properties with tenants in there, which doesn't work for an owner-occupier. They're also great options as well.
Yeah, so that's right. So if you buy a place and you think, well, it'll start returning money now, I'll start paying it off, and hopefully in 5-10 years it goes up in value, I'll do the reno then, whatever, I'll make it work. It's still a good time.
Yeah, exactly. Yeah, for sure. I think the hard thing is for owner-occupiers that are trying to upsize at the moment, because there's insufficient stock to be able to confidently sell your home and know you're going to buy the next one. So the market's definitely slowed because you've got a lot of people just sitting in their homes saying, well, we'd love to get a new house. We've grown out of this one, but the stock levels aren't there for us to make a bold decision.
Yeah. Right,
and that'll change.
It. As always, Julian, really appreciate your time. One Group, tell people about you. One Group Property Advisory. How do people get in contact with you? I'll put it up in the notes, but what's the best way to reach out to you?
Yeah, I think property is a very personal thing, so it's always best to have a chat with myself or business partner to we can just find out what your needs are and where you need some help, and we'll guide you to the right person in our team.
Fantastic. Mate, really appreciate it. Thanks for your time. All the listeners out there, thank you for tuning in again. If you want to know more about Prosperity, about what we do, go back, listen to some of the other podcasts, jump on the website, prosperity.com.au. Brendan Campbell, as always, and Julian, thank you very much for your time.
Thanks, Brendan.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.